Hi guys, today I want to talk to you about 4 hottest stocks on the market right now to buy or trade in July of 2020. Notice these companies or these stocks that I'm about to talk to you are as hot as a pistol, so I'd be careful with them and would try to buy them on a pullback rather than throwing my whole account into them without thinking. However, at the right prices, these stocks have the potential to double, triple, or even quadruple your money in the long run. So it's important to understand what these companies do and why they have such a huge potential. To start, just click the like button below, and if you haven't subscribed, please do so. I'd love to hear what you think of these companies and where you think the prices of these stocks are going. Let me know in the comments. You may also want to check out my Patreon club where I post most of my trades daily. A link is in the description of this video. Let's go. First company is Tortoise Acquisition Corp, stock symbol SHLL. Tortoise is a special acquisition company which recently announced that it will be merging with privately held electric powertrain truck company called Helion, with the combined company to be listed on the Nasdaq under the new stock symbol HYLN. Tortoise is really a shell company with money. They were looking to make an investment in a promising renewable energy company, and Helion fit the bill. So really the company we need to look at is Helion, and that company presents some very interesting prospects. First of all, if you look at this deal between Helion and Tortoise, it's very similar to Vector IQ and Nikola deal. Instead of going public through a traditional IPO, which is usually a very expensive and time-consuming process through which investment bankers and lawyers probably make as much money as the owners do, the company, which in our case is Helion, will merge with an already publicly trading company, in our case is Tortoise Acquisition Corp. Helion has 2 product lines. One is a system that turns an existing diesel-powered heavy truck into a hybrid, increasing its range and efficiency. It can be retrofitted to existing Class 8 trucks from any of the major manufacturers. Its second product, called Hypertruck ERX, is a complete electric drivetrain for Class 8 trucks, with the twist: it doesn't require a huge battery pack. Instead, the Hypertruck system is designed to be recharged while the truck is underway via a natural gas-powered generator or hydrogen fuel cell. Helion's Hypertruck ERX, which is expected to be released next year, will have the cost of ownership of only nearly $280,000, while Tesla's battery electric vehicle trucks would cost 56% higher at $438,000. Nikola's fuel cell electric trucks are the most expensive, at $637,500 due to much higher fuel costs over the years. Helion's Hypertruck ERX seems to beat Tesla and Nikola in many features. It has the most extended range, the lowest refuel time, and the highest payload capacity. Interestingly, Helion isn't planning to manufacture the product itself. It has contracted with an auto industry supplier called Dana Corporation to manufacture the products and ship them directly to installers or truck manufacturers. The combined company will have $520 million in cash on its balance sheet and no debt. But here's where things get interesting. And if you own shares of Tortoise or planning to buy it, you really need to understand this. Once the transaction is completed, shareholders of Tortoise Acquisition will own 14% of the combined equity. At a price of $10 per share, the equity in the company is being valued at $1.62 billion. By my calculation, at $25, it will be worth a little more than $4 billion. Considering that Nikola trades at $23 billion valuation as of the timing of this video, even if Helion will trade at $10 billion valuation, it still indicates to me that more than 100% upside from these levels. Yes, your shares will be prorated and you will get less shares of the new company, but still, the huge upside is there, and I would buy the stock even at these somewhat elevated levels. Next stock is Fastly, stock symbol FSLY. Fastly stock has been on absolute tear in the last 4 months. If you think Shopify or Zoom stocks have been hot, please, those are child plays compared to Fastly, with its stock rising from its low of $10.63 set in March of 2020 to where it trades today around $86 as of the timing of this video, which is a gain of 809% in 4 months. Remarkable. Fastly is a provider of content delivery network. You would say, what the heck is that? And I totally can relate to that question. Content delivery network is a way for companies to speed up delivery of content to their users. So Fastly would approach, for example, Spotify and say, do you want your users to access your content faster? Then use our content delivery network. Fastly also allows developers to build applications on their platform designed for faster delivery and optimization. With so many people and companies are moving online, Fastly has found itself in the middle of this digital transformation as the demand for their services grew tremendously lately. Fastly's customer list is a bleeding-edge technology and cloud companies, including Shopify, Vimeo, Pinterest, Spotify, Slack, GitHub, and others. These companies are seeing large usage spikes in the current macro environment. When you couple this list of customers that are performing quite well in this pandemic-driven economy with the fact that Fastly has limited exposure to industries affected by the pandemic, it is no wonder that the management has increased full-year guidance. There are, of course, significant risks to this story too. First of all, Fastly does not have positive free cash flow. In fact, its free cash flow margin is currently minus 25%. But on the bright side, it appears to be improving fairly quickly. There's also a danger that over time, Fastly's major customers may decide to develop their own content delivery networks. If this happens, it could have a serious impact on the company's financials and stock price. Speaking about the stock price, at almost $86 as of the timing of this video, the valuation is almost at half the valuation of Akamai Technologies, which is a very well-established player in this space, with majority of market share, solid balance sheet, and earnings. So with much smaller market share and negative margins, Fastly looks to be very expensive. Nevertheless, the digital transformation opportunity for Fastly is still huge. We know the company is raising its outlook for the year and revenue growth will be strong in spite of the recession. However, as a new investor, I would wait for the stock price to come down to establish a new position. Next company is Plug Power, stock symbol PLUG. Just like Fastly, shares of this company have been on a crazy run in the last 4 months, rising from the low of around $2.50 set in March of 2020 to what it is now at the timing of this video at $9.10, which is a 364% return. First of all, what is Plug Power? According to Wikipedia, Plug Power is an American company engaged in the design and manufacturing of hydrogen fuel cell systems that replace conventional batteries in equipment and vehicles powered by electricity. Basically, the company is trying to replace conventional electric batteries and carbon-based fuels with the environmentally clean and efficient hydrogen fuel cell systems that convert hydrogen to electricity. Back in September of 2019, Plug Power was forecasting revenue of $1 billion in 2024. Now management is upping its target. Today the company foresees $1.2 billion on the top line in 2024 as a result of 2 recent acquisitions, United Hydrogen Group and Giner ELX. According to management, these 2 transactions will further enhance Plug Power's position in the hydrogen industry. The company expects the acquisitions to contribute to company's profitability in 2024. But the big boost to Plug Power and other renewable energy stocks came at the end of June from California, after the state has passed regulations that will require trucking fleets to produce zero emissions by 2045. Starting in 2024, there will be a gradual phase-in of zero emissions requirements, and the ultimate goal is to be emission-free by 2045. Hydrogen fuel cells are a natural answer to the new requirement because they enable quick fueling and longer range than electric vehicles, at least given today's technology. That could provide an opportunity for Plug Power. Overall, a very intriguing company to say the least, but of course there are risks to consider as well. The biggest risk to me in Plug Power is the fact that the company has a long history of diluting shareholder value by issuing more shares, and recently it started to accumulate more debt as well. And I want to see the light at the end of the tunnel of when the company plans to become profitable. So the bottom line is at $9.10 a share, I would wait for at least 30% pullback before considering a long position in this stock. Last company I want to talk about is Workhorse Inc., stock symbol WKHS. How can I not mention Workhorse? Just like 3 stocks I've mentioned before, Workhorse stock has been on fire. rising from its March low of $1.32 to where it closed at $20.91 on July 2nd. I'm not even going to calculate the percent on that return. It's obviously crazy. Workhorse has been a public company for several years, but it hadn't drawn much investor attention until recently, and lately it has drawn a lot of attention. If you're not familiar with Workhorse, you probably already guessed it. This is another electric vehicle company, but with the twist. The electric vehicle overall market has been growing by leaps and bounds in recent years. Costs have come down to the point where electric vehicles can be cost competitive without subsidies. However, Workhorse is not just another electric vehicle company. They have carved out an interesting niche for themselves. Workhorse is focused solely on so-called last mile delivery. Last mile delivery is the final delivery step from the transportation hub to the customer. This is a niche the company calls an $18 billion market opportunity. The company has partnered with logistics and delivery companies such as UPS, USPS, DHL, FedEx, Ryder, and others. Workhorse offers not only electric vehicles but also aircraft monitoring systems and technology that are less harmful to the environment. For example, they have an exposure to the drone market with a drone product called Horsefly that can carry 5-pound packages up to 10 miles, and management says they have received significant interest from government and healthcare agencies about Horsefly. Personally, I don't think this can result in a significant market opportunity for Workhorse, but it certainly doesn't hurt. Also, they recently exited the EV pickup truck market, but they did so in a potentially profitable manner. Workhorse granted Lordstown Motors to license to manufacture the Workhorse W15 trucks in exchange for 10% equity stake in the company. In addition, Workhorse will receive a royalty on all of the electric pickups delivered by Lordstown. So, very interesting and promising company to consider. However, in order to grow, Workhorse will need more capital, and a big rise in the stock price is always an opportunity to tap capital markets. The mistake many companies make, however, is diluting their existing shareholders too much, either by selling stock at below market prices or by including equity sweeteners like warrants that can give investors the right to pick up shares on the cheap in the future. As of the stock price right now, let's take a look at the chart. Notice I highlighted a big green bump at the top. This is called a relative strength indicator, or RSI. When RSI is above 70, the stock is considered to be overbought. Workhorse stock has RSI right now sitting at almost 97, which is crazy high. I don't even recall seeing RSI on a stock being that overbought in my 20+ year investment career. But RSI is not an ideal indicator, and the stock can stay overbought for a long time and still go higher. However, as a new investor, I realized that the recent excitement about renewable and clean energy companies took the stock to an unforeseeable height, and even though I like the company, I would wait for the stock to come down before establishing a new position. And I hope you like this video, guys. Let me know in the comments below what you think of the companies I mentioned. Like, subscribe, and share. Until next time.